bomb the Japanese dropped on the markets on Monday night. I've been talking on this podcast about the ridiculous yield curve control policy going on in Japan right now, where the Bank of Japan has committed to keeping the yield on a 10-year Japanese government bond at 25 basis points.
BRICS and Japanese central banks dropped a bombshell in the U.S. economy, Peter Schiff. BRICS is working on a new global currency that will replace the U.S. dollar. Is the gold standard the next global currency? And if so, what will happen to the dollar? Japan's central bank has chosen to loosen monetary policy to bring price inflation under control, in contrast to the majority of other central banks around the world who have chosen to tighten monetary policy. However, in an unexpected move, the Bank of Japan increased its target range for the yields on 10-year Japanese bonds, which increased the effective interest rate. The action boosted the yen's value, which put more strain on the already struggling dollar and shook up the global bond market. As a result of the news, the value of the Japanese yen rose. On the other hand, the dollar's value dropped versus the yen by as much as 3.3%. As a result of the surge, the yen's value rose against the dollar to its greatest extent in a single day since March 1995. The dollar's falling value had a ripple effect on the gold market, resulting in the price of the yellow metal increasing by more than $30 an ounce and climbing back above $1,800. There is a school of thought among financial analysts that the Bank of Japan is mulling the possibility of raising interest rates. According to one investment expert who spoke to CNBC, the decision is being read as a sign of testing the water for a potential removal of the stimulus which has been put into the economy to try and spur demand and wake up prices. Peter Schiff stated his belief that the Bank of Japan will be forced to permit Japanese bond rates to move considerably higher in the future, which will affect the price inflation rate in the United States. There will be further price increases in the United States. This indicates that the currency's value and the asset price will continue to decline while inflation will increase. The dollar will lose its value due to higher interest rates in Japan. Because of this, the price of our imports rises. Additionally, it will increase commodity prices in general and put upward pressure on interest rates in the United States. These increased rates will be passed on to customers in the United States. In addition, he noted that the yield on a Japanese bond of 50 basis points is still unacceptably low. Therefore, to maintain the interest rate at its current artificially low level, the Bank of Japan will have to continue purchasing bonds, resulting in additional rate increases.
Nobody wants to loan money to the Japanese government at just 25 basis points, so the only way to keep the yield that low is for the Bank of Japan to buy the JGBs that nobody else wants. The problem is, in order to do that, they have to print even more yen, creating even more inflation, therefore creating an even greater desire to sell Japanese government bonds. And that is the no-win scenario that the Bank of Japan faced. The reason that people don't want to buy 10-year Japanese government bonds that yield 25 basis points is because inflation is much higher than that. But the only way for the Bank of Japan to keep rates that low is to create even more inflation to buy those bonds. So it's like a dog trying to catch its tail, it's never going to do it. Well, on Monday night, the Bank of Japan announced that it was raising that yield target from 25 basis points to 50 basis points, basically doubling the yield that it would allow on Japanese government bonds overnight. And of course, that immediately sent yields surging. They haven't hit 50 basis point yet. The highest I saw, I think, was 45 basis points. As I am recording this podcast now, I checked where the yield closed on Friday, and Japanese government bonds went out at 0.37 yield, so below the 50 basis point ceiling. But I believe that before too long, the yield on the 10-year JGB is going to be stuck right at 50 basis points, the same way it used to be stuck at 25 basis points, because the yield is still too low. The government is artificially suppressing yields, and so everybody is going to want to sell. The only buyer of those securities is going to be the Japanese government bond. They actually realized this because at the same time they announced that they're going to allow the yield on the 10-year JGB to go from 25 basis points to 50 basis points, they also announced an expansion of their quantitative easing program. Talk about mixed signals, because those policies are at odds with one another because they're tightening and easing at the same time. But I think they realize that there is no way to maintain 50 basis points. They couldn't maintain 25, and they won't be able to maintain 50, which is why I know they're going to go up to 75. They're going to go up to 100, because the Bank of Japan is going to have to create just as much inflation to artificially maintain the yields at 50 basis points as they did at 25 basis points, which means eventually they're going to give up. In a way, what the Bank of Japan did was a pivot, because everybody has been waiting for the Fed to pivot. Nobody noticed the pivot in Japan, because up until now, Japan was the last holdout of the major central banks because they weren't fighting inflation at all. In fact, by pegging the yield on a 10-year JGB at 25 basis points, the Japanese already decided that higher inflation is better than higher interest rates. Well, the problem is, if you have higher inflation, you're gonna have higher interest rates. And the more yen the Bank of Japan prints to buy JGBs to prevent higher interest rates, the higher the inflation rate is gonna rise. The reason higher interest rates are such a big problem for the Japanese government is because the Japanese government has so much debt. The Japanese government debt to GDP is 270%. That's twice the debt to GDP in the United States, even if you include the state and local governments. 50% of that debt is owned by the Bank of Japan. And the reason the Bank of Japan owns all that debt is because they had to print all this yen to buy all those bonds, because according to the Bank of Japan and the government of Japan, remember Abenomics, the whole purpose of Abenomics was higher inflation. The economic theory in Japan was that we didn't have enough inflation, that if we only had more inflation, we'd have a stronger economy. That, of course, was an asinine theory, and I pointed out the absurdity of it in real time. Of course, it's the same nonsense that we're getting from the European Central Bank, from the Bank of England. Even the Fed bought into the idea that we need inflation in order to have economic growth, and we can't risk deflation. That's the worst possible thing. So the Japanese government was deliberately creating inflation because they said it was too low. And in fact, if you look at where inflation was in Japan, going back to 2015, the inflation rate averaged between 0 and 1% a year. So they weren't even near 2, because they were not even at 1. We had a couple of points in 2018 where the year-over-year rate got above 1%. But in fact, in 2021, the rate actually got to negative 1% year over year. So they actually slipped into the dreaded deflation. They had falling prices. Now, of course, all hell didn't break loose in Japan because the cost of living notched down a little bit in 2021. But of course, when your policy is 2% inflation, you freak out when you get a -1. And so they kept on printing and printing money. Well, now the non-existent problem of too little inflation has become a very real problem of too much inflation. I've explained many times on this podcast why it's absurd to believe that low inflation is a barrier to economic growth. The idea that nobody is going to spend unless prices are rising is absurd. And first of all, economic growth doesn't come from spending. It comes from the opposite of spending. It comes from underconsumption, savings, and capital investment. That's what grows the economy. But to the extent that you want to look at the demand side of the economy, the best thing to help demand is when prices go down, because when prices go down, you could buy more. As we're learning right now, prices are rising and it's destroying demand, because as prices go up, people spend more money on the necessities and they have less money left over for everything else. But if you had a declining cost of energy, if you had a declining cost of food, if rents were going down, if a lot of your costs were going down, that would free up purchasing power to buy more stuff. So falling prices promote economic growth, not the other way around. People don't have an unlimited amount of money, and the cheaper things are, the more stuff they can buy. Businesses aren't even hurt by falling prices, because if their costs are falling along with prices, they maintain their margins and they make a greater profit because they have higher volumes, because they can get more sales at lower price points and therefore earn more money even if the prices are lower. So it's all nonsense that we need rising prices to have a growing economy. And part of the reason for the fear of falling prices is they go back to the Great Depression and they look at the fact that prices went down during the Depression and we had a depression, and they make the faulty logical conclusion that it was the falling prices that caused the depression.